Mastering Stock Trading, a Beginner's Guide. Welcome to our channel. Today, we're diving into the essentials of stock trading. Whether you're a complete beginner or looking to refine your skills, this guide will help you get started on the right foot. Opening your gateway to the market, brokerage accounts. Let's kick things off with the first step in your stock trading journey, opening a brokerage account. Think of a brokerage account like your personal gateway to the stock market. It's where you'll deposit funds, place trades, and manage your investments. With so many brokerage options out there, it can get overwhelming, but trust me, choosing the right one is crucial. Go with a reputable and well-established brokerage. Look for names you recognize, ones that have been around for a while and have a solid track record. You can easily find reviews and ratings online to help you make an informed decision. Consider the fees associated with each brokerage. Some brokers charge a flat fee per trade, while others have a tiered system based on your trading volume. Make sure you understand the fee structure and how it aligns with your investment goals. Another important factor is the trading platform and tools offered by the brokerage. Look for things like real-time quotes, charting tools, research reports, and educational resources. Once you've narrowed down your options, it's time to open an account. Fueling your investments, depositing funds. You've got your brokerage account all set up, congratulations. Now it's time to fuel your investments by depositing funds. This is basically transferring money from your regular bank account into your brokerage account, giving you the buying power to start investing. The process is usually pretty simple and can often be done directly from your brokerage's website or mobile app. You'll typically have a few different options for depositing funds, such as linking your bank account using a debit card or even mailing a check. When linking your bank account, you'll need to provide your bank's routing number and your account number. Most brokers don't charge fees for deposits, but it's always a good idea to double-check their fee schedule. Once you've initiated the transfer, it can take a few business days for the funds to clear and become available in your brokerage account. Knowledge is power researching stocks. It's time to talk about one of the most crucial aspects of successful stock trading, research. Before you even think about hitting that buy button, you need to do your homework. We're aiming for long-term success. A great place to begin is by looking at a company's financial statements. These statements provide a snapshot of a company's financial health. There are plenty of resources available online that can help you break them down and make sense of the numbers. Next, delve into the company's industry and its competitive landscape. Understanding these factors will give you valuable insights into the company's growth potential and its ability to generate profits. You've opened your brokerage account, deposited funds, and thoroughly researched your chosen stocks. Now it's time for the exciting part, placing your first trade. But hold on, let's break down the different types of orders you can place. The most common types of orders are market orders and limit orders. A market order is like saying, buy this stock right now at the best available price. It's the quickest way to get in on the action, as your order will be filled almost instantly. However, with a market order, you're not guaranteed a specific price. If the stock price is volatile, you might end up paying a higher price than you anticipated. That's where limit orders come in. A limit order gives you more control over the price you pay. You set a specific price or limit at which you're willing to buy or sell the stock. Your order will only be filled if the stock price reaches your limit. This helps you avoid overpaying for a stock or selling it for less than you want. Congratulations on placing your first trade. Now that you're officially a stock market participant, it's essential to stay informed and monitor your investments regularly. The market is constantly moving, and staying on top of your portfolio's performance is crucial for making timely and informed decisions. Think of it like tending to a garden. You wouldn't just plant your seeds and forget about them, right? You'd water them, fertilize them, and keep an eye out for any pests or diseases. Similarly, with your stock investments, you want to track their growth, identify any potential risks, and make adjustments to your portfolio as needed. Some investors prefer to check their portfolios daily, while others are comfortable with a weekly or monthly review. The key is to find a routine that works for you and stick to it. Keep an eye on the overall market trends. Let's talk about a common mistake many beginner investors make: going all in too soon. It's natural to get caught up in the excitement of the stock market and want to throw all your money at it, especially when you see others seemingly making huge profits. But trust me, starting small is the key to minimizing risk and maximizing your learning experience. Think of it like learning to ride a bike. You wouldn't hop on a motorcycle for your first ride, would you? You'd start with a smaller, more manageable bike, gradually building up your skills and confidence. By starting with a small investment amount, you give yourself the opportunity to get comfortable with the process, understand how the market works, and learn from your mistakes without risking significant losses. A good rule of thumb is to invest only what you can afford to lose without it impacting your daily life or long-term financial goals. By starting small, you're essentially dipping your toes in the water, getting a feel for the temperature before diving in head first. Don't put all your eggs in one basket. Diversifying your portfolio. Let's talk about a crucial concept in investing: diversification. Diversification is all about spreading your risk across different assets and sectors to protect your portfolio from the inevitable ups and downs of the market. If you invest all your money in a single stock and that stock plummets, your entire portfolio takes a hit. But if you diversify your investments across multiple stocks, bonds, real estate, or other assets, the impact of any single investment's performance is minimized. One approach is to invest in different sectors of the economy. Instead of putting all your money into tech stocks, you could allocate a portion to healthcare, consumer goods, energy, and other sectors. Another strategy is to invest in different asset classes. Stocks, bonds, real estate, commodities, and cryptocurrencies all have different risk and return profiles. By including a mix of these asset classes in your portfolio, you can potentially smooth out your returns over time. Patience is a virtue riding out market fluctuations. The stock market can be a roller coaster ride of emotions. One day, you're riding high on gains, the next, you're white-knuckling it through a downturn. It's natural to feel tempted to react emotionally to these fluctuations, but trust me, patience is key to long-term success in the market. One of the biggest mistakes investors make is panic selling during market dips. When you see your portfolio value dropping, it's easy to get scared and want to sell everything before it goes down any further. But remember, what goes down often comes back up, and selling at a loss locks in those losses. Short-term market fluctuations are like hills in a marathon. They're a natural part of the journey. Instead of reacting emotionally to every dip, focus on the long-term potential of your investments and trust in your research. Time in the market is often more important than timing the market. Finding your trading style. Exploring different strategies. Let's dive into the exciting world of trading strategies. There are countless strategies out there, each with its own set of risks and rewards. The key is to find a strategy that aligns with your investment goals, risk tolerance, and time commitment. One popular strategy is day trading, which involves buying and selling stocks within the same trading day to capitalize on short-term price movements. Day traders live for the thrill of volatility and often use technical analysis, charts, and indicators to identify trading opportunities. However, day trading is not for the faint of heart. It requires significant time, skill, and discipline, and it can be highly risky, especially for beginners. On the other end of the spectrum, we have long-term investing, also known as value investing. Long-term investors focus on identifying undervalued companies with strong fundamentals and holding on to those investments for years, if not decades, to benefit from their long-term growth potential. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more tips on trading and investing. The stock market can be a powerful tool for building wealth, but it's essential to approach it with the right knowledge, mindset, and a healthy dose of patience. Happy trading!